The mortgage interest tax deduction. It's one of the biggest financial scams around. You're seduced into thinking you're saving money, but you're not. Not sure about what I'm talking about? Keep watching and you'll see exactly how the mortgage interest deduction really works. And if you'd like to know if you've been scammed in other areas of your money, then you're going to want to subscribe to our channel and click the bell so you'll be notified when we publish new videos. We're not Smartest Wealth Systems for nothing. Hi, I'm best-selling personal finance author Tony Manganiello. Since 1995, my business partner, John Commuta, and I have taught over 3 million people how to use their current income to accumulate real wealth. And in all that time, one thing surfaces regularly. It's the mortgage interest tax deduction question. In this video, you're going to discover how the mortgage interest deduction really works because, it isn't what you think it is. There are 3 mortgage interest tax deduction facts you need to know. The first mortgage interest tax deduction fact is that it's becoming obsolete. In recent years, new tax laws have focused on simplifying the tax filing process. And one new wrinkle intended to make that tax filing process more streamlined is called the standard deduction. When it comes to the mortgage interest tax deduction, what you do is you add that to a list of other itemized deductions you may be claiming. Other deductions, in addition to the mortgage interest that you might add to the itemized list, would be things like medical expenses, charitable giving, student loan interest, and other stuff. Whatever that total is can be deducted from your gross income, thus lowering your tax liability. However, the standard deduction was created to provide what, in many cases, is a larger amount that can be deducted. For example, if you're married filing jointly and you're both under the age of 65, your standard deduction is $24,000. That's a pretty big number. If that same family is in their 3rd year of a 30-year mortgage on a loan of $200,000 at 5% interest, they would have a total of $9,623.33 in mortgage interest to write off. Compared to the standard deduction of $24,000, it's not a difficult decision as to which deduction you would choose. Now, unless this family had over $14,000 in other deductions that were allowed on their itemized list of deductions, they'd obviously choose the standard deduction. Since the standard deduction is going to be greater in most cases, the mortgage interest tax deduction provides no tax benefit at all because they can claim the standard deduction even if they don't pay mortgage interest. The second mortgage interest tax deduction fact is that the math just doesn't add up. There are many ways in which you can determine just how much of an impact the mortgage interest tax deduction will provide you if you're choosing itemized deductions over the standard deduction. And let's take an extreme example to prove my point that the math just simply doesn't add up. Let's say that you jump through all the hoops and your itemized list of deductions is really long, and it turns out that the mortgage interest tax deduction can bring your tax liability down by 30%. Now, I'm using this 30% as an overestimation to prove a point here. What this means is that you're paying $1 in mortgage interest to save you 30 cents in taxes. Did you catch that? You pay or lose $1 in interest to save 30 cents. Now listen, if you'd like to trade $1 for 30 cents, I have tons of quarters and nickels just waiting for you. Do you see how the math just doesn't add up in your favor? When it comes to the mortgage interest tax deduction, you're seduced into believing that you're saving money on your taxes, but that savings is actually costing you much more than you save. Now, did you know that the standard deduction was rendering the mortgage interest tax deduction obsolete? Or have you ever realized that your mortgage interest tax deduction was actually costing you more money than it's saving you? Let me know in the comments. The third mortgage interest tax deduction fact is your mortgage payment doesn't have to be a permanent or lifetime bill. In today's consumer culture, people seem to be mortgage hopping more than they're job hopping. And mortgage lenders are constantly bombarding you with ads that tell you that they can save you hundreds of dollars a month on your mortgage. And if you take them up on their offer, guess what happens? While you may be saving a few bucks every month, you've pressed the reset button on your mortgage. Now here's what I mean. Take a peek at this table of mortgage interest. This table is a breakdown of how much of your monthly payments are applied towards interest on a 30-year mortgage throughout the first 7 years of that mortgage. And we're looking at mortgage rates ranging from 3 up to 6%. Let's say you borrow $200,000 to buy your house and you got a 30-year mortgage at 5% to buy it. Your principal and interest payments would be about $1,073.64 a month. In the first 7 years or 84 months, you'd make principal and interest payments totaling $90,185.76. Just guess how much of that small fortune was applied towards interest on your 5% mortgage. I hope you're sitting down. $66,079.10. That's over 73% of all of your monthly payments. Now, when it comes to your mortgage interest tax deduction, this would have meant that you would be deducting $66,079.10 from your taxes over the past 7 years. And this is if you had more itemized deductions than the standard tax deductions would have allowed you. But I digress. If, and I do mean if, you were in a 30% tax bracket, that would mean you would have saved 30 cents in taxes for every dollar in mortgage interest you paid, or a total tax savings of $19,823.73. Now, the flip side of this is if you didn't have a mortgage. And we've been teaching people how to pay off all of their debt for nearly 3 decades, so not having a mortgage, it's totally possible. So, if you didn't have a mortgage, and over the past 7 years you didn't write off $66,079.10 in mortgage interest, you would have had to pay that 30 cents in taxes for every dollar of income. This would mean you would have kept $46,255.37. So which would you rather have? $19,823.73 or $46,255.37? Now, I hear you. I really do. You're thinking, but Tony, if I have to choose between rent or mortgage payments, at least I get some tax relief from the mortgage payments, right? No. Well, first, that's only if your itemized deductions are greater than your standard deduction, because if your standard deduction is greater, you're not going to claim your mortgage interest deduction, are you? And in most cases, your standard deduction will exceed your itemized list of deductions, and as a result, the mortgage interest you're paying provides you no tax benefits at all. Because remember, you get the standard deduction whether or not you have a mortgage. And yes, I do realize you just can't write a check for $200,000 to buy a house, so that makes the mortgage necessary, but that doesn't necessarily make it permanent. The only thing that makes your mortgage permanent is mortgage hopping. And instead of thinking about how much you could save if you refinance your mortgage, you need to be thinking about what your life would be like without a mortgage payment or any debt payments at all. But using the mortgage interest tax deduction to justify having a mortgage, well, that's exactly what your mortgage broker wants you to think. To break free from this insane cycle the payment mentality has you imprisoned in, you need to get your hands on a copy of The Banker's Secret to Permanent Family Wealth by my business partner, John Commuta. The Banker's Secret will walk you through not just how to pay off all of your debts, including your mortgage, it will also show you how you can use the same money that you're paying all your debts off with to build yourself a stockpile of tax-free cash. For more info on The Banker's Secret, click the link below. And while you're clicking that link, click the like button and let me know if you like this video. And please subscribe to our channel so you can continue to learn how you can be smart with your money. Quick question for you. Did the math in this video help you? I would love to know, because when it comes to you accumulating wealth, it's all about the math. So drop me a comment and let me know if the math in this video helped you gain a deeper understanding about how your money works. And if you have any other questions about money topics and would like me to break down the math on those topics, let me know, because I read the comments every week and I'm always looking for ways to help you become as smart with your money as you can be. Because let's face it, it's up to you to make sure the financial decisions you make will benefit you as much as possible. And if by any chance you're still thinking that a mortgage is a good idea because you've been conditioned to believe mortgage is good debt, then you're going to want to check out our Money Mythbusters videos, because the good debt myth isn't the only money myth costing you a fortune. Thanks for watching, and I'll see you next time.